Hey guys, what's up? I'm Erin and welcome back to the channel. Index funds have become wildly popular since their inception back in the 70s. Investors sing their praises. They're low cost, tax efficient, and basically just a low maintenance way to invest. They're a true triple threat, and this helps them to outperform actively managed funds on the regular. And I am right there with these investors. I love index funds. Index funds have been the bulk of my portfolio since I was about 17 years old. But some people think that the traditional index fund is flawed and that it could use a bit of a revamp. Index funds exist in practically every sector of investing. The most commonly referenced index fund is the one that tracks the S&P 500. Traditionally, index funds are market weighted, meaning the larger companies make up a greater percentage of the fund and capture a larger number of your dollars when you invest. Keep in mind, there are 500 companies that make up the S&P 500 index. But let's say you invest $1,000 into an S&P 500 tracking index. Automatically, $71 goes to Apple, $60 goes to Microsoft, $37 to Amazon, $24 to Tesla, and $42 to Alphabet or Google. As a matter of fact, almost 1/4 of your entire investment goes straight to the largest 10 firms. The remaining 75% of your investment gets spread out among the remaining 490 companies. That's what it means to be market weighted. Larger companies make up a greater percentage of the marketplace and thus capture a greater percentage of investors' dollars. Smaller companies capture a smaller percentage of those dollars. Investors' dollars are distributed according to a company's share in the marketplace. A relatively new perspective is that perhaps investing a larger percentage of investors' dollars to the largest companies isn't the best approach, but rather maybe spreading those dollars out equally to all companies in the index might yield superior returns. And thus we have the creation of the equally weighted index as opposed to the market weighted index. In an equally weighted situation, let's say again you invest $1,000 in an S&P 500 tracking fund. In this case, your dollars would be spread equally among all 500 companies, regardless of their size. In this case, $2 would go to each company. The argument for equally weighted funds is that these larger companies have a disproportionate influence on the overall performance of the fund, in both directions, of course. Let's say Apple, Microsoft, and Amazon all have a bad day. Well, the odds are that the entire fund had a bad day at that point, regardless of how the other 497 companies performed. But remember, the reverse is also true. If they had a good day, it's likely that the fund had a good day too. Based on their size, they can skew the overall market performance. And this does seem to be pretty common sense. Larger companies do exert a greater force on the market, and thus they are going to disproportionately influence these index funds in both the positive and the negative direction. If you invest in equally weighted funds, you're sort of shielded from the big movements of the corporate giants, as you're investing equally in all companies. It's also worth considering that Apple, Microsoft, Amazon, Tesla, these companies have not always been the kings of the index. In fact, over time, the companies that reign supreme have frequently changed and will likely continue to change in the coming years. But if you more evenly distribute your investing dollars, you may very well be in a better position to capture in on those gains of those rising stars once they do start moving up the index that are currently only a small share of the overall index. Is this perhaps a better way to invest than the traditional index fund? Should the traditional index fund be laid to rest? Well, not so fast. Let's look at how these equal weighted indices have performed compared to the traditional market weighted index. Well, quite honestly, there's not really that much of a difference long term. Over the past 10 years, both have moved in a pretty similar fashion. Until about 2016, the equal weighted ETF was marginally ahead. But around 2018, the market weighted fund took the leap ahead. And now, after this year's downturn, they're back to being in about the same place. I think the big takeaway here is that there are going to be times when the giants of the index fund outperform, but there's also going to be times when the smaller companies that make up the index outperform the larger companies. And we don't really know when these times are going to occur. When the giants outperform the smaller companies, that's when the market-weighted funds are going to come out ahead. When the smaller companies are victorious, well, the equally weighted funds are going to come out ahead in those times. But there is an important note to be made about these equally weighted funds. Remember the benefits of the traditional index fund, its incredibly passive nature, tax benefits, low fees? Well, when it comes to equally weighted funds, they aren't quite as passive in nature. As such, they have higher fees associated with their more frequent rebalancing. And this more frequent trading activity means that if you hold these funds in a brokerage account, aka a non-tax advantage account, you will likely face a higher tax bill. The fees for the equal weighted funds are still relatively low as far as funds are concerned, much lower than actively managed funds that tend to have an expense ratio of around 1% or so. But as far as passively managed funds are concerned, it is on the higher end. Now, which of these fund types will perform best over the long term, equal weighted or market weighted? Well, we don't really know. Only time will tell. And a lot of investing comes down to personal preference. If you think the smaller companies that make up the index will be responsible for a greater percentage of the gains, maybe equal weighted index funds are worth exploring. However, if you are fine with a company's market share size dictating how your dollars are invested, well, then traditional index funds and ETFs are a great place to stay. Now, there are other whispers about index funds in general. First off, some have made the argument that index funds are making companies lazy. The argument here is that if shareholders own both Microsoft and Apple, or both Coke and Pepsi, the companies lose the incentive to compete for a greater market share. The companies innovate less, and they settle for basically being suboptimal of what they otherwise could be. In the long run, this would hurt consumers and investors alike. Quite frankly, I don't know how much I buy into this. I get that as a passive investor, if my strategy is just to buy and hold the index, I may not care one way or another how each individual company does, just that the index as a whole performs well. However, my passive investment choices do not drive my consumer habits. If Apple creates a new technology for their phone, for their watch, for their MacBook, I am more inclined to buy the product. Their job as a company is to make me want to buy products, and they do that through innovation. Just because I hold both Apple and Microsoft in an index doesn't eliminate their rivalry as competitors. They still want to grow their market share. They want to grow their respective business. They want to maintain their market share. And also they still want to clobber their competitor just a little bit. Remember this, just because these companies are on the index today does not mean they have a guaranteed position there in the future. They have to fight for it. That means they have to earn it. The fact that Amazon and Walmart now sit on the same index doesn't mean they just turn to each other and say, well, we both made it, let's just take it easy. Of course not, that would be silly. The other argument against index funds is that it has created a bubble. Investing in index tracking funds and ETFs has become more and more popular over the years. In 2010, index funds made up 19% of the fund market. By 2020, they had made up 49% of the fund market. As more and more investors turn to index funds start to exert a greater sway on the marketplace. With more and more people funneling their investing dollars to an index, this increases the demand for the individual stocks or companies that make up that index. So these stocks inherently receive a little bit of a boost. Those stocks that are not included in the index do not get that type of boost. This is actually so common that it has a name. It's called the S&P phenomenon. The S&P phenomenon is a temporary increase in the price of a stock upon the announcement of its inclusion in the S&P 500 index. This occurs because the index is widely tracked by institutional investors. When a stock is added, funds that follow the index buy the stock. The theory is that indexes have created a bubble and that all the stocks that are held within the index, the prices of them are artificially inflated simply because they are part of the index. And we all know bubbles can't last forever. Eventually they burst. But we should put a greater emphasis on the word temporary here. Yes, once a new stock is announced to become part of the index, all the funds that track that index in the short term have to purchase that stock. So in the short term, the price of the stock will be affected. But in the long term, this should not affect the overall stock price. Long-term stock price is set by a company's overall performance and health. It is set by the expectations of investors. It is not set simply because it belongs to an index. Ultimately, I think you can hear that I'm a huge fan of index funds. I think they are a phenomenal way to invest. I like their low fees. I like that they are tax efficient. I like that the barriers to entry are low. You can get started with $25 or $2,500. And when you get started, you have instant diversification. At the end of the day, I think the pros outweigh the cons. What are your thoughts on index funds? Do you think there's a bubble? Do you think equally weighted funds are better than market weighted funds? Let me know in the comments down below. I read every single one and reply to as many as I possibly can. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I hope you have a great day. I'll see you soon. Bye. Index funds have become 10 years old. Practically, oh my gosh, greater percentage of a larger percentage ETFs has to be, they exist in practically percentage of as more and more investors turn to index, as more and more, oh my gosh, and more of those first that are right now, percentage of investors funds is that clients outperform the weighted companies of the index going to occur. Oh!